Hi, welcome to the third part of the factor investing series. So far we have discussed a broad overview and we discussed equity as premium and certain corroborative factors. But today really the deep dive into the big factors happens. The value factor, later on followed by size factor, momentum factor, and then others. Today is the real deep dive into one of the important factors, the value factor. This is especially important for people who follow the fundamental based approach to investing, where people look at the balance sheets and P&L and cash flow statements and try to derive judgment on the intrinsic value of the company and try to buy at a discount to intrinsic. So let's dive into the value factor today. So, value factor and value investing more or less is the same thing. Value investing is more doing things by hand, and value factor is more letting the machines have a go at it, letting the computers go at it. But essentially, it's the same thing. There's not much of a difference between the value factor and value investing. Essentially, you are trying to buy things at a discount, or you are trying to buy things uh, cheaper than what they are actually worth. So, as Buffett says, buying a dollar bill for 50 cents or buying a rupee for 50 paise. So, it's nothing but buying shares at discount to intrinsic value. Let's get this question out of the way first, because if you have been following the financial press or if you have been on social media or things like that, this question periodically pops up, and currently it's a hotly debated topic. Is value investing dead? Now, uh, this question had come about in the late 90s when .com was in a frenzy. It came into uh, fashion maybe in 2007, where uh, all the in India, where all the real estate and infra companies started shooting up in stock price and things like that. So the question frequently pops up: is value investing dead? And this is the headline from Economic Times. This was in March 2020, so pretty recent. CNBC is asking the same question. So some columnist for CNBC has asked the same question, and here the answer is also there. So the article also mentions what killed value investing. So not only is the question there, it's presumed that value investing is dead, and we are trying to find out the culprit, the person who killed value investing. Uh, this is Financial Times. Again, this is 11th of May 2020, and with a prominent picture of Warren Buffett. So it is asking the question: does value investing still make sense? So, if we are going to talk about the value factor or value investing, then it's essential to have an answer to this. So, are we going to waste time on something which really does not work in the marketplace? So, let's get the context right. So, typically, the question arises at the time of underperformance of Buffett or Berkshire. This happened in late 90s. And currently, again, I'm not trying to make excuses for Berkshire or Buffett, but currently they've not been doing that great as compared to the S&P 500. And if you compare it with Nasdaq, then the performance is even shorter. So uh, again, the some of the uh, run-ups in stock prices have been in companies like Amazon, which arguably are very, very expensive in terms of, at least optically, in terms of the price earning ratio. Netflix, again, seemingly very, very expensive. Some companies which hardly make any profit, companies like Tesla and all, again, are stock prices are shooting up. Some of the startups like Uber and WeWork and Oyo and all have got funding at fantastic valuations. So the question arises that does buying boring companies at a discount to intrinsic still work in the world? So to answer that question, firstly we need to have an answer to this question as to what is value. When you are saying value investing or value factor, what really is value in the context of equity shares or equity investing? So, if you ask a finance professor, the answer will be the value for any investment is the present value of the cash flows from the investment. So, whether it be a stock, whether it be a bond, whether it's a real estate investment, whether it's leased assets, whatever it may be. So, you calculate the future cash flows from any investment. You figure out at what time period you will get those cash flows, and then you have a cost of capital or the rate of return that you require to discount those cash flows to the present value. Now, this sounds jargonish or this sounds complicated, but actually, the formula to do this calculation is taught to most people in high school in algebra. So, essentially, it's use of compound interest formula, amount after a certain period equal to principal multiplied by 1 plus r raised to the number of periods after you get the cash flow. So, to discount a cash flow, instead of multiplying that term with p, you take it to the other side and divide a by 1 plus r raised to n. That means you get the present value of the cash flow. So, the formula is very, very simple. And even if you are allergic to math, you can put it in any calculator or in any Excel or a Google sheet or something, and you can easily get the answer. The problem, as far as equity investing goes, is somewhat different. It's not the math. The problem with equity shares is you do not know what cash flows will come in the future. What will be the sales of a company, what will be the cost of raw materials, what will be the salary costs, all of those are uncertain. So what will be the profit and cash flow of a company in the future is very, very difficult to ascertain, and each person can have their own estimates. So in which case the value becomes very, very subjective whenever practitioners calculate value of any equity share. So, given that there is so much uncertainty in terms of measuring value, what do people do? So, uh, as I said, practitioners of value investing do it by hand. They take each company, they estimate the worth of the company by whatever metric, whether it's DCF or by some of the proxy methods. But DCF really is not possible for people using the value factor in the quant terminology. So, if you want computers to do screening for you and computers to give you a list of companies to buy, then DCF is not very useful because you don't have the DCF value for the companies that you are evaluating. So in practice, people use proxies to estimate value. So people use price to book value, price to earnings, or the P ratio, EBP ratio, price to sales, price to free cash flow, enterprise value by EBITDA. So various proxies are available to measure the value of a company or of an equity share. And for historical reasons, so if you have read Benjamin Graham in Security Analysis and in Intelligent Investor, uh, Graham was more of a balance sheet investor. So he looked at book value and the cash or the liquidation value and the net current assets of a company and things like that. So he was a big fan of book value. And for whatever reasons, academicians have used uh, price to book as the measure for the value factor. Whenever they uh, try to tilt their portfolio towards value, they use price to book. And academic research and some of the practitioners also, people who use quant, use price to book as a measure. Some, not all. So keep that in context. And when people talk about value, uh, typically people say the opposite of value is growth. That's the typical perception. So if you see these style boxes on various websites which uh, compare mutual funds and things like that, so there is value style and there's growth style. That is what typically is measured in the media and by a lot of trackers. So even some of the people who provide indices say there is a value style and they capture the value performance, and then they say there is a growth style and they capture the growth performance. So, for example, in the US, there is something called the Russell 3000 Value Index. Now, I'll take a minute to actually read out what they are saying because this is important. How do we define value? So it says in the text on the screen about the index, the Russell 3000 Value Index measures the performance of the broad value segment of the US equity value universe. It includes those Russell 3000 companies with lower price to book ratios. So it's using price to book as a measure of value, and surprisingly it's also taking lower forecasted growth values. So it is deliberately choosing low growth companies. So it uses this measure to evaluate the performance of value stocks. Now let us look at what they talk about growth index. They have a value index and they have a growth index. So here they are taking the exact opposite of what they did for value. They are now taking higher price to book ratio companies and they are taking companies with higher forecasted growth. So this is high price to book, which is expensive companies as per them, and high growth companies. And then they compare and contrast these two indices. And this is the reason why this story keeps coming about. So let's look at the performance of the uh, value index and let's look at the performance of the growth index. So value is on top and growth is on bottom. So look at the 1 year performance. Value is down by 9.5%. Growth is up by 22%. Look at the 10-year number. Value is just 10.23. Growth is up 16.92. And index is somewhere in between. So value is absolutely stupid strategy to run. Index is somewhere in between, and growth is a great strategy to run based on these numbers alone. And these are the numbers that were referenced to in the Financial Times article that we saw just a few slides ago. The slide with Buffett's picture in it, which said that value is not such a great strategy to use. You should actually be using growth. And based on these numbers, one would be tempted to conclude that value is a dead strategy and one should not pursue this too much. In fact, it can be injurious to wealth and you would underperform the index, let alone meeting or beating it. However, uh, these guys who make the indices and write all these articles have not caught up with their reading. They haven't caught up with their Buffett reading over many, many decades. Let's look at what actually Buffett said in 1992. Not something recent, but in 1992. Pretty long back, right? I'll read out uh, a lot of text because this is important. not only on this slide but on the following slides. So Buffett is asking the question, how do you decide what is attractive in terms of valuation? Most analysts feel they must choose between two approaches. Indeed, many investment professionals see any mixing of these two terms as a form of intellectual cross-dressing. We view that as fuzzy thinking. In our opinion, the two approaches are joined at the hip, always a component of value, constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. So the highlight of this slide is Buffett says growth is a component of value. It's not something separate. So growth has to be factored in while calculating the intrinsic value of any equity share of or any security. Let's look at what he says in addition to that. So he says, in addition, we think the very term value investing is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value in the hope that it can soon be sold for a still higher price should be labeled speculation. So Buffett essentially in this slide is saying all investing is value investing. Look at what he says further. He is beating down the proxies. He is saying typically what constitutes value investing is buying low price to book companies, low PE companies, high dividend yield companies. But he says that such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it's worth and is therefore truly operating on the principle of obtaining value in his investments. And he says the flip side also should be considered. Correspondingly, opposite characteristics, a high ratio of price to book, a high price earning ratio, and low dividend yield are in no way inconsistent with a value purchase. Let's take a moment here. He's saying you can buy a high PE company and still be doing value investing. And he says you can buy a low PE company or a low price to book company and still not be value investing. So this is something which is to be kept in mind, both by practitioners of value investing and by people who create these indices and split the universe into value and growth. Now he comes specifically to growth. Buffett says business growth per se tells us little about value. It's true that growth often has a positive impact on value, sometimes one of spectacular proportions, but such an effect is far from certain. For example, investors have regularly poured money into the domestic airline business to finance profitless or worse growth. For these investors, it would have been far better if Orwell had failed to get off the ground at Kitty Hawk. The more the industry has grown, the worse the disaster for owners. Growth benefits investors only when the business in point can invest at incremental returns that are enticing. In other words, only when each dollar used to finance the growth creates over a dollar of long-term market value. In the case of a low-return business requiring incremental funds, growth hurts the investor. So we come to a situation where Buffett is combining the two approaches. Buffett is not only talking about low price to book, low price to earning kind of companies. He's saying you have to incorporate growth and whether that growth is at decent rates of return on capital into your valuation. Further, Buffett says that in the theory of investment value, written over 50 years ago, John Burr Williams set forth the equation for value. The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. Note that the formula is the same for stocks as for bonds. Even so, there is an important and big distinction. We spoke about this because the cash flows from equities are uncertain. So we saw that earlier in the slide. Okay. So now we are at a stage where the practitioners of value investing, led by Mr. Warren Buffett, have thoroughly demolished that low price to book or low price to earning itself determines intrinsic value or value investing. Whereas people who make the indices or whereas people who compare value versus growth are still at it. They still uh, have a style box of value versus growth. So, given that a lot of the people who are indexers and a lot of academicians who measure the value factor still use price to book, let us look at the issues with using book value, especially in today's context. At Graham's time, maybe book value was an important measure of calculating intrinsic value. But today, the situation is somewhat different. Let's look at what the issues are. Firstly, the book value of two different companies, may be the same, but the intrinsic value may be dramatically different. Let us say one company is 50, 60 years old, which has bought residential flats in prime localities 50 years back. And the other company is 2-year-old company where they have bought residential flats just last year. Now, the book value may be the same in both the companies, but the market value or the true value may be very, very different. Same way, people would have set up plants, people would have invested a lot of advertising dollars into building brands, and they may be reflected at very, very low book values on their books, or sometimes may have zero book value. So, advertising expenses typically uh, pass through the P&L and does not come on the balance sheet. So the big book value of HUL may not have uh, the brand values on the balance sheet. So whereas some other company may have acquired brands from uh, other companies, and there the brand value may be there on the balance sheet. So inflation, time differences, and various other factors can play havoc with the book value. Again, the accounting policies may differ. Some people may be capitalizing interest cost while construction of a factory. Another company may be uh, creating the factory out of internal accruals, and there may not be any capitalization of interest. As I mentioned, some companies may have acquired brands or acquired some certain assets at market value, and the book value will tend to look larger than some other companies which have old assets. Intangibles, I mentioned things like brands, patents, R&D expenses, and all those things will not reflect in their true value on the balance sheet. Again, some of the financial assets have mark-to-market accounting, which plays havoc with the book value again. There could be some unreported losses. So, for example, in banks, now, does it mean that a bank trading at 1 time price to book is cheap and a bank trading at 4 times price to book is expensive? Maybe not, because the bank which is looking cheap may not have fully accounted for the NPAs on its balance sheet. So, book value is not the sole or the correct measure to ascertain value. But if you are going to use quants as a framework instead of doing value investing by hand, what's the alternative? You are forced to use some proxy measure. You will, if not price to book, you'll have to use price to earnings, you'll have to use price to free cash flow, or price to sales, or something you have to use to figure out whether things are cheap or expensive. So while DCF is the only correct method of calculating value, we have already seen that it's not practical in the quant world. So what proxy to use? So you could use price to book, you could use price to earnings, you could use price to free cash flow, or you could use EV/EBITDA kind of a measure, which uh, does not differentiate between debt-based and fully equity-based capital structure. So it takes the true profitability of a business into account. So various measures are there, and there are various pluses and minuses. Or some people have advocated using a composite. So composite, again, different practitioners can have different approaches to using a composite measure of value, but it may eliminate, for example, a EV/EBITDA kind of measure for financial companies like banks. It may weigh book value based measures more for certain cyclicals where book value still continues to be giving some good signals of intrinsic value. So composite can be created in different manner, but essentially composite will take various valuation measures into account rather than use only one measure. So again, I'll present some data, but don't focus too much on the data itself, because different providers of data may have different versions of it. The essence is to see how a book value based approach is not the best approach, and something which is either cash flow based or earnings based or composite gives far better results uh, when using the value factor in the quant methodology. So this is from a website called factorresearch.com. So you can look it up on the website. It's quite interesting. And this gives the returns for the US stock markets, different metrics and uh, comparative returns. So if you look at the purple line, light purple at the bottom of the screen, that is the index. Now, clearly, the value factor has done well over the last 18, 19, 20 years. Value factors have been outperforming the index. But if you look at the uh, dark blue or dark purple line, sometimes it departs from the light purple line and then again goes back and hugs the light purple line. That is the price to book measure of value factor. So depending on starting point and ending point, the price to book measure may seem to be dead as a factor which leads to outperformance. However, when you look at the other factors, other value factors, be it price to earning, be it price to free cash flow, be it EV/EBITDA, or be it multimetric or composite factors, then those do lead to reasonably large amounts of outperformance over longer periods of time. Again, we mentioned this in the first uh, episode itself, first segment of factor investing itself, that factors do not work all the time. Factors work only on an average over long periods of time. So there will be periods where value factor underperforms, there will be periods where value factor outperforms. But over long periods of time, on an average, it will tend to outperform. But the result, to my mind at least, seems to be very, very clear that academics need to move on beyond price to book or book to market, as they call, and move towards more cash flow based measures or earnings based measures or EV EBITDA kind of measures. You cannot continuously use price to book and say value is not performing. Now, this is only one part of it. So, when you use just the value factor, as we saw on the previous slide, where you rank different companies based on PE ratios or based on EV, EBITDA, or price to free cash flow, and buy into the top 10% cheapest companies. That is one way of doing value investing. But that is not, again, the only way of value investing, and that is not the correct way of value investing, in my opinion. So the question is, should Hindustan Unilever and NTPC trade at the same P ratio? Now, let us say, hypothetically, if NTPC is available at 10 times price to earning and Lever is available at 12 times price to earning, will you buy NTPC over HUL because it's cheaper? That would be the result if you use strict quant based ranking methodology based only on PE. But obviously, all of us know that ROE of HUL would be higher, arguably growth prospects may be better, and things like that. So, obviously, quality also comes into play. So, value investing is not only about buying cheap, it's buying quality at a reasonably attractive price. So, here comes the quality overlay. And Joel Greenblatt has captured this aspect in the magic formula that he describes in the little book that beats the market or still beats the market. He's done a composite ranking. He's ranked companies on basis of cheapness, based on their earnings or uh, earnings adjusted for capital structure. So more likely like a EV EBITDA kind of valuation. So he looks at cheapness, but he also looks at quality. So the highest quality companies get a better ranking. And then he combines the two rankings, ranking for cheapness with ranking based on high return on capital. And based on the joint rankings, he recommends investing in companies. And he has back tested this, and it works reasonably well over long periods of time. Then again, this book, Quantitative Value, takes this further. It does evaluations of various combinations as to what really works well, and it tries to improve upon Joel Greenblatt's magic formula. So essentially, what one should do is take the combined rankings of cheapness and quality, and if you can throw in the growth rates, that would be even better. But even combining quality with cheapness by itself does a fair bit of improvement over just ranking for cheapness. So just ranking for cheapness gives somewhat better returns than the index, but does not really give you that much bang for the buck. So that, in short, is the discussion on the value factor. So we will discuss the nuances of implementation of the quant factors in a later episode, or maybe after sufficient time has passed, we will have another round of actual implementation-based series or videos. But thank you for joining us on this journey of exploring passive investing. Thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.